Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about the 5 riskiest investment strategies to avoid. So make sure to watch the full video. 1. Day trading. Day trading involves buying and selling securities, such as stocks, within the same day with the goal of making a profit from small price movements. Day trading is a high-risk investment strategy for several reasons. High volatility. Day trading involves buying and selling securities within a short period, often a few minutes or hours. This means that the trader is exposed to high volatility, which can result in significant price swings in a short period. This volatility can make it difficult for traders to predict future price movements and can result in significant losses. High leverage. Day traders often use high leverage to increase their potential returns. This means that they borrow money from their broker to invest in securities, which can magnify the gains or losses on their investments. If the trade goes against them, the losses can be significant and can exceed their initial investment. Emotional pressure. Day trading requires traders to make quick decisions under pressure. This can be emotionally challenging, especially if the trader is losing money. Emotional decisions can lead to impulsive trades and can result in significant losses. Lack of diversification. Day trading typically focuses on a few securities, which can limit the trader's exposure to other market sectors. This lack of diversification can increase the trader's risk and can result in significant losses if the market moves against them. High transaction costs. Day trading involves frequent buying and selling of securities, which can result in significant transaction costs, such as commissions and fees. 2. Options trading. Options trading is a highly speculative and risky investment strategy that involves buying and selling options contracts, which give the holder the right, but not the obligation, to buy or sell an underlying security at a certain price, the strike price, on or before a specific date, the expiration date. Options trading is risky for several reasons. Complexity. Options trading is a complex investment strategy that requires a significant understanding of options contracts, including their terms and conditions, pricing models, and different types of options. It can be challenging for inexperienced investors to understand and evaluate the risks involved. High volatility. Options contracts are highly sensitive to changes in the underlying security's price and volatility, and the prices of options contracts can fluctuate significantly in a short period. This can make it difficult for traders to predict future price movements and can result in significant losses. High leverage. Options trading often involves high leverage, which can magnify the gains or losses on the trader's investment. This means that traders can lose more than their initial investment if the options trade goes against them. Limited time frame. Options contracts have a limited lifespan and expire on a specific date. This means that traders must make their trading decisions within a limited time frame, which can be challenging, especially in a rapidly changing market. Limited liquidity. Some options contracts have limited liquidity, which can make it difficult for traders to buy or sell options contracts at their desired price. This can result in traders being unable to close their positions or take profits when they want to, leading to significant losses. 3. Emotional pressure. Emotional pressure can arise from several factors, such as fear of missing out, FOMO, fear of losing money, or overconfidence, FOMO. FOMO is a common emotional pressure that can lead investors to make impulsive investment decisions. For example, if an investor sees that a particular stock or asset is increasing rapidly in value, they may feel pressure to buy in to avoid missing out on potential gains. However, this can lead to poor investment decisions and significant losses if the market reverses. Fear of losing money. Fear of losing money is a common emotional pressure that can lead investors to make irrational decisions. For example, if an investor sees that their portfolio is declining in value, they may panic and sell their investments, even if this is not the best decision for their long-term investment strategy. Overconfidence. Overconfidence can also be a significant emotional pressure for investors. For example, if an investor has had recent success with a particular investment strategy, they may become overconfident and take on more risk than is appropriate for their investment goals and risk tolerance. Emotional pressure can be particularly risky for inexperienced investors who may not have the knowledge or experience to manage their emotions effectively. Investors should work to develop a disciplined investment strategy and to avoid making impulsive decisions based on emotional pressures. Working with a qualified financial advisor can also help investors manage their emotions and develop a long-term investment strategy that is appropriate for their investment goals and risk tolerance. 4. Lack of diversification. Diversification is the practice of spreading an investment portfolio across different asset classes, industries, and geographies to reduce risk and increase potential returns. Lack of diversification can leave an investor vulnerable to significant losses if a particular asset class or industry experiences a downturn. For example, if an investor puts all of their money into a single stock or sector, they are exposed to the risk of that specific stock or sector. If the stock or sector performs poorly, the investor's entire portfolio could suffer significant losses. Diversification can help investors manage risk by spreading their investments across different asset classes and industries. This can help to reduce the impact of any single investment on the overall portfolio. For example, if an investor holds a diversified portfolio of stocks, bonds, and other asset classes, the impact of a decline in one asset class may be offset by gains in other asset classes. Investors should work to develop a diversified investment portfolio that is appropriate for their investment goals and risk tolerance. This may involve investing in a mix of asset classes, such as stocks, bonds, and alternative investments, as well as spreading investments across different industries and geographies. Investors should also regularly review and rebalance their portfolios to ensure that they remain diversified and aligned with their long-term investment goals. 5. High transaction costs. Transaction costs refer to the fees and commissions that investors pay when buying and selling securities, such as stocks, bonds, and mutual funds. High transaction costs can erode an investor's returns and make it more difficult to achieve their investment goals. High transaction costs can be particularly risky for investors who engage in frequent trading or who hold a portfolio of individual stocks or other securities. For example, if an investor is buying and selling stocks frequently, they may be paying high transaction costs for each trade. This can add up quickly and reduce the investor's overall returns. High transaction costs can also be a risk factor for investors who hold a portfolio of individual stocks or other securities. In this case, the investor may be paying high commissions and fees to buy and sell each individual security. This can make it more difficult for the investor to achieve diversification and can increase the overall risk of the portfolio. To manage the risk of high transaction costs, investors should consider investing in low-cost index funds or exchange-traded funds, ETFs, that track a broad market index. These investments typically have lower transaction costs than actively managed funds and individual securities. Additionally, investors should consider their trading strategy and try to minimize the number of trades they make, as this can reduce transaction costs over time. Finally, investors should carefully evaluate the fees and commissions associated with their investments and work to minimize these costs where possible. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.